Have you ever wondered why we sometimes make irrational choices with our money? Well, the answer typically lies in our cognitive biases, a topic that often goes unnoticed but yet has a profound impact on our finances. Welcome to Concepts Made Simple, where we aim to simplify everyday financial and self-improvement topics. If you're looking to get control of your finances and make smart financial decisions, be sure to like and subscribe to the channel down below. In today's video, we'll explore the impact of behavioral biases on financial decision-making and how they can affect our financial well-being. We'll cover off different types of biases and discuss strategies that can be used to counteract these biases to help improve our overall financial situation. Confirmation bias. Confirmation bias is our tendency to seek out information that confirms our existing beliefs or opinions while ignoring or dismissing contradictory evidence. When it comes to finances, confirmation bias can lead us to selectively consider information that supports our financial decisions, which may not always be the most rational approach. For example, imagine Grace, an investor, has a strong belief that a particular tech company stock will perform exceptionally well. Instead of conducting a thorough analysis of the company's financials, she selectively looks for news or articles that support her belief and disregards any negative information. Although it may not always be intentional, it is our tendency to seek out information that is aligned with our beliefs. This becomes even more dangerous in today's day and age as social media looks to feed us information that is aligned with our previous content we have engaged with. And there's a good chance that the content we have engaged with is stuff that aligns with our beliefs, potentially filtering out alternative perspectives. So how can we counteract confirmation bias? A great first step is proactively reminding yourself that confirmation bias does exist and it can have an impact on your personal finances. Instead of ignoring or getting angry when you see a piece of information that doesn't align with your beliefs, try taking a step back and looking at it from a different perspective. For example, even though Grace has a strong belief that a tech stock she is investing in will go up, she should also look to seek out information from other sources who may believe the stock is headed in the opposite direction. This will help Grace better understand both sides of the spectrum and ultimately make a more rational decision. These same principles apply to really any financial decision you make, whether it be purchasing a stock or determining a strategy to pay down debt. It's important to actively seek out diverse perspectives and challenging viewpoints. Engaging in constructive debates, consulting with financial advisors, and conducting thorough research can help us make more well-rounded and informed financial decisions. Loss aversion. Loss aversion is rooted in our strong desire to avoid losses rather than seeking gains. Loss aversion plays a significant role in how we perceive and respond to financial risk. Studies have shown that the pain of losing is psychologically more intense than the pleasure of gaining. This bias can lead us to make irrational decisions when it comes to managing our finances. Let's take a look at an example. Let's imagine John, an investor, purchased shares of a company that subsequently started declining in value. John is now faced with a difficult decision, whether to sell the stock or hold on to it. Despite evidence suggesting that selling the stock might be a wise decision, John holds on to it because he's afraid of realizing his losses. This type of behavior can typically be attributed to loss aversion. John's fear of incurring a loss is stronger than his desire to cut his losses and move on. By holding on to the declining stock, he hopes that his value will rebound, avoiding the emotional pain of accepting the loss. However, by succumbing to loss aversion, John may miss out on better investment opportunities or continue to experience further losses. This bias can prevent us from making rational decisions based on objective analysis and can negatively impact our long-term financial well-being. To overcome loss aversion, it's crucial for individuals to focus on long-term perspectives and adopt a diversified investment strategy. By diversifying their portfolio and considering the potential gains alongside the risk, individuals can make more balanced decisions that align with their financial goals. Many professional stock traders cite their ability to cut their losses as playing a critical part in their success. This is a great example of how overcoming loss aversion can turn into a financial advantage. It's also important to regularly evaluate investments objectively, without letting the fear of losses cloud our judgment. By assessing the potential risk and rewards of holding on to an investment, individuals can make informed choices and avoid being solely driven by the desire to avoid losses. Remember, personal finance is not just about the numbers. It's about understanding ourselves and our biases. By being mindful of these biases, we can navigate the complex world of finance with greater clarity and make more informed choices for our financial future. If you found this video to be helpful, be sure to like and subscribe to the channel down below to stay up to date on a wide variety of everyday financial and self-improvement topics. Thank you for watching, and we'll see you in the next video.